How IPO pricing really works is often misunderstood, because many people assume the price of a newly public company is simply based on its value or future potential. But in reality, IPO pricing is a carefully managed process shaped by investment banks, market demand, timing, and psychology. And when a company decides to go public, it does not pick a random number for its share price. It hires investment banks, known as underwriters, whose job is to evaluate the company's finances, growth prospects, risks, and comparable public companies to estimate a reasonable valuation. And this valuation becomes a starting point, not the final price. Because the real goal of an IPO is not to maximize price on day one, but to balance demand, stability, and long-term trust. And underwriters begin by marketing the company to large institutional investors through a process called a roadshow, where executives present the business model, strategy, and financials. And these investors provide feedback on how many shares they are willing to buy and at what price. And this feedback helps underwriters build a demand curve that shows where interest is strongest. And based on this information, a price range is set rather than a single price, allowing flexibility as demand becomes clearer. And one surprising aspect of IPO pricing is that shares are often intentionally underpriced, meaning the IPO price is set slightly below what the market might pay, and this is done to ensure strong demand, reduce the risk of a failed offering, and reward early investors, creating positive momentum and headlines when the stock rises on its first trading day. And while this first-day jump may look like a loss for the company, it actually builds credibility and encourages long-term investor confidence. And timing plays a major role in IPO pricing, because market conditions, interest rates, and overall investor sentiment can dramatically affect demand, meaning the same company could receive very different valuations depending on when it goes public. And this is why companies often delay or rush IPOs based on market cycles rather than business readiness alone. And allocation also matters, because most IPO shares are distributed to institutional investors, not the public. And these investors are chosen based on their reputation, long-term investment behavior, and relationship with underwriters, helping stabilize trading after the IPO. And once the stock begins trading publicly, the underwriters may support the price temporarily through stabilization activities, but after that, the market takes control, and the share price begins reflecting real-time expectations, performance, and sentiment. And the biggest misconception about IPO pricing is that it reflects true value, when in fact it reflects a negotiated balance between risk and demand at a specific moment in time. And for retail investors, understanding this process helps explain why IPOs can be volatile, overhyped, or disappointing after launch, and why buying at the IPO price does not guarantee future gains. And the key lesson is that IPO pricing is not about perfection. It is about coordination, trust, and risk management. And companies, banks, and investors all aim to create a successful transition from private to public markets, knowing that long-term performance matters far more than day one